Hello and welcome to everybody. Today we are talking about your business taxes. So today we are talking to business owners about the different types of business taxes that they will experience. Things like income tax, GST, and all the other fun BAS taxes, as well as talking about dividends if you run as well. So today we're going to run through and a whole load of different concepts from our slide deck and run through. So what I'd really love is some interaction in the chat. So we'll be monitoring the chat for any questions that you have. So if you want to say a nice little hi in the chat box and say where you're calling from or where you're joining from today. I'm joining from Indonesia. So a beautiful sunny day today, no thunderstorms. Hi Beck, how are you? And the internet is a little bit slow today, so hopefully that doesn't impact on your viewing side of things. So we're going to jump straight in, and I'm going to share my screen. So with a beautiful picture of me on there. So time to know your taxes. Hi Kobe from Karapa, how are you? Hopefully it's a beautiful sunny day in Karapa. So time to know your taxes. So today we're going to run through the slide deck and show you, give you some understanding around what taxes that you will come across as a business owner. So at Northwest Accountancy, we've really filtered down the 4 different areas that we help our clients with. And the first one of those is, well, not the first one, but one of those is timely taxes. So we help our clients with all lodgements on time, minimizing tax and preparing early for tax bills. So this is the reason why I've created this webinar for you today, so that you can understand the different taxes there are and prepare early for them as well. So it's not a surprise. So the type of taxes, we'll talk about how you can minimize some of those taxes, what record keeping you need to do to maximize your tax deductions and therefore minimize the tax you need to pay, how we calculate your taxable income and therefore your tax to pay, some of the mistakes that we see and how to avoid them, as well as at the end, we'll run through a little bit of our elevation training program, which runs through not only tax, but other areas of running your business as well. Okay, so first of all, who am I? Why am I here? My name is Jodi Porteous. I'm the Chief Educator at Northwest Accountancy. I've been an owner of Northwest Accountancy since 2003. So yes, there's a little bit of maths in there. 20-year anniversary this year of being at Northwest Accountancy. I'm a tax agent, I'm a Profit Fest master, and my superpower is to explain away the jargon and help you understand tax and money so that you can easily run your business. Now, over the last 3 years, so I've been working at Northwest Accountancy for 20, but over the last 3 years, I've really changed on how I show up for the business. And instead of preparing hundreds of tax returns every year, I've started pivoting and doing more work around advising business owners on how to make their business more successful. Why am I here? My mission is to help business owners set up their business so that it can support their lifestyle. And this means making sure the business is set up with the right systems and procedures to make it easy to run, teach owners how to run the right reports and how to track the business, to make sure that your taxes are done on time without being scared of the taxman. So that's why you're here. And of course, cash being king is a big focus on helping business clients set up a cash flow system so that they've always got money for taxes. Now, we'll be talking about money for taxes throughout some of the slides as well. So what question I have for you, if you want to stick the answer in the chat, is do you think you know enough about taxes that you could have a general conversation, or is it really something that's quite scary? So is taxes scary to you or okay? where do you stand on there? Okay, great, fantastic. So this is just going to boost your level of understanding then rather than freak you out. So today we're going to run through all the different types of taxes. But before we did, I just want to talk about the 4 key areas that Northwest Accountancy focuses on for our clients. So timely taxes, I just went through. Then we've got cash flow clarity. So this is around stop juggling funds and make real profits to support your lifestyle. So we believe that your business should be there to support your lifestyle. Also, setting up a structure for your business. So designing it so that it can survive at really peak times of really busy, lots of money coming in and doing really well, but also survive in those times of turbulence as well. And then the final piece being relevant reporting. So having that accurate bookkeeping and understanding your numbers so that you can understand how your business is going without having to do an accounting degree. And our motto down the bottom, partnering with you to get your business off the ground to set up the business of your dreams. Okay, so let's have a look at the different taxes we're covering today. So the first one being income tax, and we'll spend a reasonable amount of time on this because this is complex and it is quite calculation heavy and there's lots of different rules associated with it. I'm not going to deep dive into rules, but I'm going to tell you how to calculate income tax and how it works. Then we've got goods and services tax. So that also involves everything to go on business activity statements as well. So fuel tax credits and FBT. Then we've got employee taxes, so pay-as-you-go withholding, capital gains tax, land tax, transfer duties. So land tax and transfer duties are state taxes. And then finally, we'll run through dividends and franking credits and how they can apply to the taxes that you pay as a company and as the individual taking those dividends out. And for each of these topics, we'll cover what it is, how it's calculated, the record keeping requirements, common myths and mistakes. So let's jump straight into income tax. So income tax is calculated on your taxable income. Now, your taxable income is generally the profit of your business, and you can see this on your profit and loss report. However, your profit and loss report isn't the cash of your business because your profit and loss report excludes GST. It excludes things like purchase of vehicles and equipment that are coded to your balance sheet, to your fixed assets accounts. And it excludes owner payments, such as drawings or dividend payments. So it's your profit and loss only and it's shown on an accruals basis as well. So your profit and loss is not a full reflection of the money coming in and out of your business. Your profit and loss is a report that we use predominantly for tax purposes. So this is the report that we use to generate how to calculate what's on your tax return versus what is going in and out of your business. So the accruals basis piece is an important piece for bigger businesses who have large invoicing that clients don't always pay on time. So the accruals basis is more of a timing situation. So whenever you generate an invoice and send it out to your customers, it will show up in your profit and loss report straight away without having that requirement of it being paid by the customer. So you might generate an invoice on today, the 10th of May, and the client not pay you until July. So this will show up on the May profit and loss report, even though you don't physically get paid until July. So that timing is really important to understand. We calculate your tax return based on the timing of what goes into that profit and loss report. So when it comes to record keeping for income tax, we want to look at a bookkeeping software. that saves you time. So if you are running your business and you're running on a spreadsheet, then that's absolutely fine. But if you only have a few transactions, it's not going to take you a lot more time. Bookkeeping software, you've got multiple transactions going through every week or every month, then having software that links with your bank accounts will really help you save time on that data entry. Then we also recommend a regular rhythm in the diary to do your book work. So having a set schedule in your calendar. So you do your books on Monday, for example, Monday's money day, and you can repeat that as a mantra. Every Monday, go in and do all the books so that you keep up to date on a regular basis. That way, it's not a huge job to do at the end of the year. When you're using bank software, you can then use bank feeds within those rules for easy and accurate data. And this means linking up your bank statements or your bank accounts with the bookkeeping software. It'll draw all of that data through so that you can help tell what those transactions are in a nice, quick, easy manner. Then making sure you keep your copies of your receipts. So on the odd occasion, when we do get audited by the tax office, they do want to see copies of receipts. And the receipts have to show a specific amount of information, which are the date, amount, GST, what it was for, who it was from, plus the ABN or address of their business. So you can have a digital copy. And if you're using bookkeeping software, in most cases, you can save a digital copy to the exact transaction, which makes it really easy to follow back. Or you can have a paper copy. So a lot of people these days, especially using bookkeeping software, once you've done the data entry for that receipt, stick it in a shoebox. And I love the shoebox analogy because you can literally use a shoebox, shove it in there, because once it's been recorded, you generally won't need to go back to that receipt later on. And then you can go down and file them in date order or payment order or all sorts of random things. Some people even have, I've seen people file their receipts in supplier order, which is great if you need to go back and have a look at it. But if you don't need to, then why bother wasting your time doing that? Okay, so we're going to look at the profit and loss statement now. So the profit and loss statement is what we base your tax on. So your tax is calculated on your profit. So how is profit calculated? So profit is generally the bottom line on your profit and loss statement. So in this situation here, we've got a profit and loss showing a profit of $120,000. But how did we calculate that number? Well, there's a bit of maths involved. So our sales at the top of the screen, $218,000 minus the cost of sales. So the cost of sales is the amount that you spend that's a direct relation to your sales income. So for example, if you're buying books to sell books as a bookseller, then the cost of those books is that $69,000, and what you're selling those books at is the $218,000. So for some of the people on our call, I know you're definitely in that situation where you're buying things that is then sold to other customers. That cost of sales is that cost of those products or those materials or the stock that you're sending out to your customers, or you're delivering for your customers. Then we've got, so your sales minus your cost of sales is your gross profit. So your gross profit here is $148,000. From that $148,000, you've got to run the rest of your business. So we've got all the different types of expenses, and your profit and loss report is probably a lot longer than this one. I've really shortened it down just to give an idea of what can be on a profit and loss. So we've got things like depreciation, accounting fees, staff amenities, superannuation, wages, telephone and electricity. So remember, these figures are all excluding GST, because your profit and loss is an excluding GST report. So the $120,000 is what we pay tax on. Now, this is the same whether you're a sole trader or a company or operating as a trust or a partnership. This same format is exactly the same. We look at the profit and loss, we see what that net profit amount is. Now, this generally converts to what we call taxable income, and this is what we pay tax on. So for a sole trader, how this works is your income comes in and we work out based on the tax rates how much tax you're paying. In the chat, have you seen this tax table before? Have you seen this way of showing how much tax you need to pay before? With this table, it shows yes, brilliant. So with this table, it shows a breakdown of the different tax thresholds that are payable in each area. So if you earn in between 0 and 18,200, then you're paying no tax at all on that income, but only if that's your total income for the whole year. So if you've got a job somewhere else and you've got your small business being a sole trader, then we have to add those two incomes together to get your whole of your income tax return. So sole traders, if they do nothing else and have no other income, then your profit, whatever was on your profit in your profit and loss statement, is what you pay tax on as your taxable income. But if you've got rental properties, if you've got interest earnings, if you've got another job, then they all add together, and wherever you fall in that total is what your taxable income is. So going back a step, we talked about the income being $120,000. So we've got the different thresholds here. So 18,000 to 45,000 is 19 cents in the dollar. 45,000 to 120,000 is 5,092 plus 32.5 cents in the dollar. $120,000. So if you had $120,000 worth of taxable income as a sole trader, then you'll pay $29,467 of tax. If you have income of $130,000, then you'll pay the $29,000 plus another 37% or 37 cents for every dollar. So $3,700 for the extra $10,000. So we can work out and stack on where we're up to using these tax thresholds. And then top tax bracket, the more you earn over $180,000, it's taxed at 45 cents in the dollar. Now, one thing to remember about this one is these tax rates exclude the Medicare levy. So the Medicare levy is a levy that everybody pays unless you're a non-tax resident for tax purposes. So all of our tax residents pay Medicare levy unless you've got an exemption or you're a foreign resident. So the tax rates are actually 34.5%, 39%, and 47%, which include the Medicare levy. So I'll run through that in the next lot of examples as well. So with our sole traders, how do we calculate? So if our taxable income is $60,000, we're sitting here in this 45 to 120,000 tax bracket. So we have the 5,092, which is the tax on 45,000. And then we have another $15,000 worth of income to get us up to $60,000. So this at the 32.5% tax bracket is another 4,875. So we're adding those two together to get us to 9,967. Then we add the Medicare levy. So that's 2% of the $60,000. And so all up in tax, there's a total of 11,167 to pay if your taxable income as a sole trader or an individual, because they're the same, is $60,000. Please reach out in the comments in the chat if you do have any questions about calculating that tax. I think I've stepped it through okay, and I do this quite often, so hopefully that explained it well. Then we've got our partnerships and our trusts. So if you run your business as a partnership or a trust, your partnership and your trust does not pay tax on their own tax return. They don't pay tax in their own name. So what we do is we work out what the profit is based on the profit and loss statement, and then the partners of the partnership or the beneficiaries of the trust then are allocated a portion of those profits, to pay tax in their own name. So if you are a partner in a partnership, then we'd go back to that previous screen, we'd work out what your taxable income is, and we'd calculate the amount of tax. Same with the trust. If you've got a trust, then we go back. The more income you earn, the more tax you pay. So the higher taxes based on the income that you're earning. But a company is different. A company pays tax in its own name at a flat rate of tax of 25% on profit. Now, there's a little but in there. A trading company pays tax at 25% of its profit, but a non-trading company, so one who has passive income such as shares or investment properties, and that's it, they'll pay a flat rate of tax at 30%. So their tax rates haven't changed. So we're talking about business companies here, ones who are actually active and trading in business. So if you're trading in business and your profit on your company profit and loss statement is $60,000, then you'll have tax to pay of $15,000. If your company makes a profit of $120,000, then your tax is $30,000. So double the income, or double the profit, double the tax when it comes to companies. But that's not the same as individuals. So let's have a little comparison here. So I've included the Medicare levy so you can see a full tax side of things. So at the $60,000 tax bracket or taxable income amount, an individual will pay tax at 18.6 effective tax rate. And what I say by effective tax rate, I've just taken the $11,000 divided by $60,000, so it works out at 18.6%. So at $60,000, an individual is paying tax of $11,000, a company at not 15%, 25%. My apologies, that slide is wrong. At 25%, the tax is $15,000. So as a sole trader, if you're making a profit in your business of $60,000, then sole trader is definitely cheaper from a tax point of view because there's less tax to pay overall. But then as we start growing our income and we have taxable income of $120,000, we can see there that that's now starting to get to be the same amount. So just ticked over. So it's around that $115,000, $117,000 mark where we tip over from an individual being cheaper to a company being cheaper. So at $120,000 worth of taxable income or profit, an individual pays $1,867 more in tax than what a company does. Now, if this was the maximum amount you were ever going to earn as a sole trader and you're likely to have less income in the following years, then I wouldn't bother changing to a company because of the costs of setup to set up a company and then having to do tax returns for the company every year as well as tax return for the individual every year as well. So there's different ways that we can work with tax planning to get your tax correct. Then we can see as the income increases and increases again, the more income you have as a sole trader or as an individual, the higher your tax rate is. So at $180,000, we're paying $55,000 worth of tax, which is 30% tax, but a company still pays tax at 25%. And then at $300,000, there's a huge difference. So if your taxable income's or your profit in your business is $300,000, then an individual would pay $111,000 of tax on this, but a company, a flat rate of 25% tax at $75,000. So what we like to do when we talk about tax planning is find that right happy medium between outlaying a heap of tax as a sole trader and then utilizing the tax benefits that we can have by using a company well. So when it comes to some of the strategies that we talk about in our tax planning meetings, we can talk about whether you want to change from an individual sole trader or trust through to a company to as one of the benefits of having a lower tax rate. Now, that's just one of the benefits, and I'm not going to go into a lot of the other ones today, but that's definitely one of the benefits. So a saving of $40,000 worth of tax is definitely worth it if your income or your taxable income or your profit is that high. Everyone following me? Who wants to earn $300,000? Oh. Okay, so how do we pay our income tax? So income tax is paid when we lodge the tax return. However, once we've lodged our first tax return and the tax office knows that we've had a bill in the previous year, then they'll ask us to pay tax installments in advance of the next year so that you're paying those tax before you lodge next year's tax return. It's roughly a quarter of the tax bill every quarter. So if you had a tax bill of $10,000 last year, then they'll generally ask you for $2,500 every quarter. So July to September, October, December, January to March, and then April to June. However, it's based on the timing of when your tax return is lodged as to how much you pay. So your tax return itself isn't generally due until about now. So your tax returns are due on the 15th of May each year. So if you don't lodge your tax return until the 15th of May, the tax office doesn't know that you had a tax bill for the previous year. And so when they send out the April to June installment, it's going to be a huge installment because they didn't have the time on the July to September, the October, December, and the January to March installment statements to say, hey, you can pay us these smaller amounts. So they will generally whop you with a bigger amount in that April to June, just to play catch up for the 2023 tax return or the next tax return. So timing of when you lodge your tax return can really impact on how much you have to pay. And if this is your first year where you've had a tax bill to pay, they're going to whop you with that tax bill and whop you with the installments at the same time. Don't you love my non-jargony jargon? Whop. So the tax office will give you that tax to pay on your installment statement. So it's a pay-as-you-go installment or a quarterly activity statement. Another spelling mistake there, look at me go. So if you find that this amount is too big or too small, you can definitely pay more to the tax office if you want to. You can adjust the amount that the tax office is asking you on how much to pay. However, you can't do it if the form is late. So you need to make sure that you're lodging that request to adjust to the pay-as-you-go installment before the due date of that form. Otherwise, they will just make you pay it. When pay-as-you-go installment system works properly, or the income tax installment system works properly, then when you go to finally lodge your tax return, there shouldn't be much tax to pay at all. So this is where the system's all working beautifully. The guesses are right with how much tax you're paying in advance, and the tax return is just a finalization of here's all the tax I've paid versus here's the tax I should have paid, and here's a little top up or a tiny refund. That's the ideal situation. This is the preparing early for tax bills side of things, is where we really want to make sure that everything's paid on time before the surprises hit. Some of the mistakes that we find when we're dealing with income tax. The biggest one is not keeping records, so or claiming things in the wrong name. So the big example I have with this one is a client who bought a vehicle. Actually, I think it was like a van, like a coffee van or something like that. They bought it in the husband's name and the business was in the wife's name. The tax office obviously audited it and went, okay, so you don't own it. And they denied the claim because the record was in the wrong name. So even though they had the record of here's the purchase of the vehicle, they actually missed out on the claim because it wasn't in the right business name. So make sure that that is a part as well. And if you don't have the records for what you've bought, whether it's a $300 invoice or a $300,000 invoice, then it's still going to allow, you're still going to miss out on those claims. So keep your records. The next mistake is not lodging on time. So most of the forms that we lodge, and especially income tax, there's a few different dates that we have. So I said just on the previous slide, our tax returns are due for the most part on the 15th of May. So if you lodge it next year, so if you hold on and lodge it in July 2023 for something that was due in May 2023, you could get a late lodgement penalty for lodging on time. Now, this is wasted money. Get your shit together, do your record keeping, lodge your tax returns on time. So that's an easy way to get out of late lodgement penalties. And then one of the last things that I want to bring to your attention is make sure that you're not trying to spend all of your money to reduce your profit and your taxable income to nil, because to pay no tax means there's actually no money in your business to pay any taxes at all, and that's a GST or PAYG withholding or anything like that. But it also means you don't have any money to invest in other assets or pay down loans, or the most important, to pay the owner. So this is for drawings or for dividends. You want to be able to afford to pay the owner as well. So one huge myth or mistake that I see a lot of business owners, especially between now and June, is how do I pay no tax? I know my profit shows $10,000. I'll just go buy a vehicle. But it doesn't always work like that, because we've got more money going out of the bank account than what we would have to have paid tax. So we only pay tax at a percentage. And we can have the rest of the money sitting in our bank account. Hopefully that resonates. And then last of all, making sure all your records are kept securely for 5 years after the tax return is lodged. So I've got a couple of people from Karratha on the call. We've had lots of different situations about records being destroyed, either in cyclones or by, heaven forbid, termites getting into filing cabinets. So please be aware that if you don't have those records kept securely, because the tax office can go back up to 5 years after the tax return is lodged, if you don't have those records, you can miss out on claims. So going straight back to the top, if you don't have the records, you could miss out on claims. So this is where having that digital copy is really handy, and having them saved in an accessible place where yourself and your accountant can access them. So that could be on your bookkeeping software. So is anybody going to put their hand up and say, oh yeah, I've done one of those, or I am guilty of thinking that if I spend all my money, I don't have to pay any tax, then I actually don't have any money? Next, we're going to talk about the BAS. So that income tax side of things is all about tax return at the end of the year, and we only do the income tax once a year, with the exception of those installments, which are done every quarter. Now, the business activity statement depends on where you're registered as to how many times you might do a business activity statement, and I've got a slide about that. So on your business activity statement, this is for taxes that are collected by registered businesses and are paid to the tax office on the business activity statement. So the key for this one is that you have to register for all of these different taxes in order to charge them or get a credit back for them. So on your BAS, you might find the GST, and you have to register for GST. Fuel tax credits, you have to register for fuel tax credits. Luxury car tax, you have to register for that. Wine equalisation tax, pay-as-you-go withholding, and no ABN withholding tax, which technically you don't need to register for, but it is something you pay on your business activity statement. There's always exceptions to the rules with with taxes. So let's talk about GST first. So GST is applicable to those businesses who are registered for GST. Now you are required to be registered for GST if you have income, so top line income, sales, turnover, all those words of more than $75,000. So you're required to register when you think, now this is where it gets really subjective, when you think your business is going to have more than $75,000 within a year. So it's not when you get to $75,000, it's when you think you're going to get to $75,000. That's when you're required to be registered. Because for some people, it passes them by because they're not doing their data entry and they're not paying attention to how much money they're making. And then all of a sudden they do their tax at the end of the year and go, oh, oops, I've done more than that. And then they register at that point. So it is a voluntary registration though. So if your business is turnover of less than $75,000, you can still register for GST. And this might be a strategic thing where you are looking to buy some materials or pay out some costs where you can get a GST credit back for those costs before you are earning the higher $75,000 amount. What is GST? Well, simply put, GST is a goods and services tax where we add 10% to the invoices. So if you're providing a good or a service in your particular industry, you add 10 and you're registered for GST, then you add 10% to those invoices. That 10% is not your money. It's not your money. I'm sorry, the GST amount is not yours. It belongs to the government. If you're registered for GST, you are a mini tax collector. So you have to charge the GST, collect the GST, and then pay the GST off to the tax office. So the GST is something that is really important to get the grasp of. It's not your money. It's the government money. On the flip side, when you're paying an invoice to somebody who is registered for GST, they're charging you GST, and to figure out how much GST you've paid, you can divide it by 11. So if you've paid a bill for $1,100, if we divide that by 11, that's $100 worth of GST. Now, if you're registered for GST, yes, you have to add GST onto all the invoices that you send out to other people, but you also get to claim back the GST that you've paid out to other suppliers. So this is something that can really help some businesses where they've got a whole load of purchases that they've paid. You get to reduce the amount of tax that you're paying to the tax office overall. Now, there's different rules for certain purchases and sales depending on the industry that you're in. So if you are in the health industry, then some of the services in the health industry are specifically legislated as GST free. So you're not allowed to charge on them. We've also got things like residential rent. So if you own an investment property or if you pay for rent for a residential rent, then they're specifically GST free as well. So we're not allowed to add GST onto those things. And then if you do your grocery shopping, you might notice that some of your fruit and veggies are GST free, but you pay GST on other things that you buy in the shop as well. So different rules for different things. So really pay attention to the industry that you're in and whether you have to charge GST or not. For the most part, 90% of our business clients do charge GST, and about 75 to 80% of what we buy has GST on it. So the next tip is to check the status of your suppliers on the ABN Lookup website. So just because they've got GST on a receipt or an invoice that they've given you doesn't always mean that they're registered for GST. So when you're dealing with somebody new for the first time, go to the ABN lookup website, type in the ABN that they've given you, and see if they actually are registered for GST. This website tells you whether they are or not. If they are not registered for GST, then they are not allowed to tell you, not allowed to put that 10% on. So we've got a question here. If your industry is not allowed to charge for GST, should that business really register for GST? Well, there's two trains of thoughts. Number one, no, because that'll make it really easy. But number two, if you're buying a lot of things, a lot of goods or a lot of services for your business, then you can claim those GST credits back. So when you're lodging your business activity statement, you can get a refund back every single time, or it can help to offset any wages tax that you might be paying for employees. So I would definitely register for GST if you've got a certain amount of GST credits that you pay out throughout the year, probably around that $5,000-ish mark and above. So that way you're getting back the GST that you're paying, because the GST is a straight refundable amount. So if you pay $500 worth of GST, you get a credit for $500 worth of GST. Whereas in income tax, if you pay $500, you're paying income tax at your income tax rate. So as a company, it's 25%. So it's a dollar for dollar system with the GST system, whereas it's not a dollar for dollar system with the income tax side of things. Hopefully that answered your question. So my general answer is yes, register for GST so that you can get more money back in your pocket. Right, what else is on a BAS? So we've had GST on a BAS, now we've got the fuel tax credits. So fuel tax credits is a tax back system. So if you are eligible in your industry to claim fuel tax credits, definitely do it, because this is money back in your pocket. It's a refund system. You don't actually pay fuel tax credits, you get fuel tax credits back as a refund. This refund is based on the number of litres of fuel that you have used in heavy vehicles. So heavy vehicles is classed as more than 4.5 tonnes driving on a public road. And then there's different rules for smaller vehicles travelling on private roads or mine sites. Depending on what you use the fuel for, it can be 20 to 47 cents in litre back as a credit for you. And then your fuel used in private roads or off-roads in some of these industries or areas or activities include agriculture, fishing, forestry, mining, construction, manufacturing, generator, and landscaping. So even the fuel to go into whippersnippers. So it does require a bit of record keeping. So instead of just having I paid $20 for fuel to fill up the jerry can, we've got to track the number of litres and we've got to track the usage of what it was used for. So it may or may not be an efficient use of time to spend 2 hours looking for $20 worth of credits. But if you're using a reasonable amount of fuel in your business, then you can definitely register for fuel tax credits and get some of those cents per litre back from your fuel usage. So that's the fuel tax credit side of things. Then on the BAS is also the luxury car tax. So if you've bought a car recently and it's more than $65,000, I think close is the threshold, you might have paid luxury car tax. And the luxury car tax is specifically payable by car retailers and those people who import cars. However, if we have paid luxury car tax as a general user, then we can't claim it back. It just adds to the cost of the car at 33%. So if you're a car retailer, you charge it and then pay that money to the tax office. If you're anyone else, it's an end user tax and there's nothing we can do about the luxury car tax that we pay. Same with the wine equalisation tax. So if you are a wine manufacturer or a wholesaler, or you've got a vineyard and you're selling at the cellar door, then you will charge wine equalisation tax at 29%. And yet again, it's an end user tax, so only applicable for those people who are actually selling wine to end users, so to the consumers, us who are drinking the wine. So our business activity statement has all of those different aspects on it. They have GST, has fuel tax credits, it has wine equalization credits, it has what was the other one? Luxury car tax. So it has all of those 4 aspects. It also has pay-as-you-go withholding, which I'll touch on in just a moment after I wrap up the rest of the business activity statement section. So it's a self-assessment tax form. So the tax office will generate an activity statement for you if you are registered for any of those things. So you're registered for GST, pay-as-you-go, luxury car tax, fuel tax credits, you'll get a form automatically. And at this stage, in most situations, it's a digital form. They very rarely send out paper forms anymore. So they'll generate a tax form that you have to declare your income, you have to declare the totals for each of the different assessments. And then it depends on whether you've registered as to whether you put those totals on. And then you can register monthly or quarterly, or for your GST to be annually. So let's have a look at those ones in just a moment. So depending on how you've registered, there's different variations of the BAS form. So here I've got a little list of all of the different types of taxes that you'll pay on your BAS. So you can see I've got a tick in the quarterly for all of them. So if you're registered for all of the taxes on a quarterly basis, then you'll get a BAS form with all of the boxes for all of those different taxes to pay. However, you can register on a monthly basis for GST and pay-as-you-go withholding. So if you are registered for GST and pay-as-you-go withholding on a monthly basis, you would get the forms on the months. So January and February, you would get the GST and pay-as-you-go withholding on your monthly forms. And then if you are registered for the other taxes as well, you'd get a different form for the quarter in between. Now, the confusing part is they've all got different due dates as well. So on the monthly forms, they're due on the 21st of the month after the end of month. So the form for the end of April is due on the 21st of May. However, the quarterly forms, you've almost got 2 months to pay the quarterly forms. So it's a month plus 25 days after the end of quarter. So this is for the January to March quarter. Our January to March BAS isn't due until the 25th of May. So we've almost got that 2 months to get it sorted and paid, which is great for us as tax agents helping you do your BAS, because we're helping quite a few different people doing the BASs. And so that gives us 7 or 8 weeks to get those sorted out for you. Now, with the monthly ones, there's no extensions ever. And with the quarterly one, it used to be 28 days after the end of month, plus an extra month if you're lodging online, but nearly everybody's lodging online now. So there is that 1 month plus 25 days after the end of month for every single BAS. With your monthly, it's the 21st of the month regardless. So the great thing about lodging monthly is that you need less money in your tax bank account in order to pay off that monthly bill. So you can generate those forms and get them paid quite quickly. However, there's 12 forms to pay instead of 4 forms to pay. So your bookkeeping needs to be up to date regularly, like every 2 weeks at a minimum, to be able to generate the forms that you need to be able to do your BAS on time. Now, the only one that's due annually is GST. So this, we generally just see the annual GST registrations for smaller not-for-profit or smaller sole trader businesses, where they're voluntarily registering for GST and only need to do that form once a year. So that's handy as well if you are in that situation. And that annual form is due at the time when your tax return is due, or at the end of October. If you do have any questions about when the forms are due for BASs, please put them in the chat and I will get back to you in a moment. So here's some of our recommendations with BASs. If you're good at saving money, then quarterly registrations are absolutely fine. If you are not good at saving money, or you get stressed out every single time a BAS is due, and because of the amount of money that it is, then let's register you for GST or both GST and pay-as-you-go withholding on a monthly basis. Yes, it increases the amount of lodgements, but it decreases the amount of time between when you collect the money from the customer and when you have to pay it to the tax office. So potentially bringing it from a 5-month, so from the start of the quarter to when it's due to be paid, 5-month period, down to a 1-month period of being owed and paid. So definitely less stressful doing your forms on a monthly basis. Another recommendation is to have a tax bank account and put a percentage aside of all of your income every single week or every single fortnight so that you can pay that tax as and when it falls due. Because it's really important to not only lodge your forms on time, but pay the tax on time as well to reduce the risk of interest that you have to pay because you're paying late. So having a separate tax bank account changes that mindset of I have to pay my money to the tax office to being able to say, well, that money was never mine in the first place. Like I said at the top with the GST, that money is not yours. And so if we have it in a separate bank account set aside so that it's nothing to do with our everyday operations of our business, when it comes time to do the tax return, when it comes time to do the BAS, the money should be sitting there ready to go, ready to pay. And it's an enjoyable thing to pay your BAS rather than oh my gosh, where is this money coming from? Or, oh my God, this is going to drain my bank accounts. So having the tax bank account set aside is a real game changer for a lot of businesses because it changes that mindset of I've got to pay my money to the tax office to, oh yeah, that's the tax money for the tax when it comes up. So if you don't have a tax bank account, then definitely think about using one. Note. Now, one thing about income tax is, yes, you can minimize your income tax by buying more stuff. You can't minimize your GST because it's based on the sales and the purchases. So the more sales you have, the more GST that you're adding on. The less sales you have, the less GST that you pay. So it's in direct proportion. And minimizing the amount of GST that you're paying means that you're paying out way more money than what you have coming in. And that's just going to put you in a loss situation completely and have no money left to do anything else. And we don't want you to do that. So GST is a part of doing business. So if your business is registered for GST, then pop it on the chin, have a tax bank account set aside for that GST money and just pay it, because we want you to have a BAS to pay every single month where you are collecting and paying GST. Okay, so on to employee taxes. So technically our pay-as-you-go withholding and as an employee tax is also payable on the BAS as well. I just haven't covered it to now because I want to talk about a couple of different employee taxes at the same time. So pay-as-you-go withholding is what I like to call wages tax. This is the tax we withhold from wages, pay-as-you-go withholding. And it's for any staff that you employ in your business, whether you're employing yourself as a company, employing yourself. So here's an example of a weekly pay slip. So we've got an employee, whoever it is, $30 an hour at 30 hours per week. And so that's $900 worth of gross pay. Based on this, we hold aside $127 for pay-as-you-go withholding. We pay them the net pay of $773, and then we pay an accrued or hold aside an amount for superannuation as well, which is $94.50. So this is then reported to the tax office on payday via the single touch payroll system. So it's really important to have your your payroll system set up Every business, I don't think there's any software providers now who have an exemption. So every single employer should be reporting their pays to employees to the tax office on payday or before, using the proper single touch payroll software. So once this is reported, then you get to pay it. So we pay out the $773 to the employee. So that is the amount that we pay out to the employee on payday. Then we hold aside the $127 worth of tax, and that goes to the tax office on the business activity statement, either on a monthly or a quarterly basis, depending on how we're registered. And then finally, the superannuation, which is technically not a tax, but is to be paid as a part of employee obligations. So this needs to be paid to the super fund by the 20th after the end of quarter. Now I've written the 20th. The rules, the legislation says that the super fund must receive the funds by the 28th of the month. So it's important to make sure that there's some time there to flow through from your bank account through to the super fund bank account, especially if you're using a clearinghouse. Now, a couple of things to note with superannuation. The first one is the super rate is going up in July 2023 from 10.5% up to 11%. So we've got to make sure that we've got money in our bank accounts to be able to pay that superannuation as and when that falls due by the end of every quarter. And the second one, the announcement came through last week or the week before, that superannuation is by 2026, so only 3 years away, going to be paid on payday. So if you don't have the capability of paying super on payday because you've got to wait for other people's money to come in, you want to start getting into the habit of having a tax bank account or a superannuation bank account that you can quarantine that money into, so that you've got the money available to pay that by the time they bring in those pay on the day type rules. So I can definitely help you with that when we talk about setting up cash flow and setting up the profit first methodology, is having percentages set aside so that we can make sure we've got enough money covered for those things. Right, so that was payroll, pay-as-you-go withholding. Now I'm going to talk a little bit of a curveball. So payroll tax is something that is paid for state taxes. So this is not an Australian tax office tax. This is not a federal government tax. It's a state tax. So different states have different rates and different regulations as well. So depending on what your gross pays are made to staff, if your business wages goes over a certain threshold of gross wages, then you have to register for payroll tax and you have to pay that percentage of tax to the state government. So here in Western Australia, we've got the State Revenue Department, and if your total gross wages goes more than $1 million, then it's 5.5%, or a minimum of $55,000 in tax, just because you pay $1 million in wages. So it's something that does blindside a few employers. So keep an eye on it. If your wages are up there around that $800,000, $900,000 mark, keep an eye on what your wages are every single month, because as soon as you go over that 1 million for the year, then you are required to register and pay that payroll tax, either on a monthly or a quarterly basis. Generally, we see it on a quarterly basis for smaller employees and monthly for larger employers. So this is definitely a state-based tax and will not apply to a lot of our small business users. But generally, I see where you've got around 10 to 12 employees, that's where you start to tick over that payroll tax. So keep that one in mind as well. 10 to 12 employees, start looking at whether you need to pay payroll tax. Yet again, there's always exemptions to the rule. So if you're a not-for-profit, then you may be exempt from payroll tax as well. The other things with payroll tax is it doesn't include the wages you pay for apprentices. It doesn't include wages you pay on workers' comp, parental pay, and there's some other different payments as well. So we can reduce the amount of payroll tax you're paying based on who it is that you're paying. And one of the strategies that we can use when we're doing some tax planning is if your owners are the ones tipping over that $1 million mark and everybody else you're paying less than $1 million, to reduce the amount of payroll tax, we can take you off the books and pay you a different way. So lots of different ways to minimize the amount of payroll tax if you're up there paying that higher amount of tax. The next tax that is sort of employee-employer relation, but is payable by the employer, is fringe benefits tax. Now, if you're on our existing mail out list at the moment, you would have got an email at the end of April, early May about fringe benefits tax. So this is where you are subject to paying tax if you provide non-cash benefits to your staff. So things like providing a vehicle for personal use. So you're not actually giving them cash so that they can drive around in their own car, but you're giving them a vehicle. Now, I want to specifically say that vehicle doesn't mean everything. In this situation for fringe benefits tax, we're talking car. We're not talking kitted out ute full of tools. We're not talking a van that is full of cleaning supplies. We're specifically talking about a car for personal use. And a car can also mean a four-wheel drive as well. So a Prado or a Land Cruiser will also fit under the description of what a car means for personal use. So if you own any vehicles, then it's good just to do that full review of are these cars covered under the fringe benefits tax rules or not. Then we've got housing. So if you provide housing or untaxed housing subsidies, then they may be eligible, to pay fringe benefits tax on them. So there are remote area housing allowances if you're based in a remote area like Karratha. If you are just providing housing to your employees in a main city, then there will definitely be fringe benefits tax. So this is why employers don't generally get involved in housing their employees unless they're in a remote area. Another example of where fringe benefits tax might apply is entertainment, such as meals outside of work, tickets to shows, movies, or box seats to sporting events. So entertainment is fringe benefits tax inclusive, and there's lots of general rules, but one of the general rules is if there's alcohol involved, it's generally got fringe benefits tax. So we tend to not put these costs through the business because then we're subject to additional tax. Now, fringe benefits tax, I don't know which slide that one's on. Fringe benefits tax is 47% of tax. Oh, here it is. So if you're providing a ticket to a movie or ticket to a sporting event, for example, and it's $1,000, then 47% tax on top of that. So another $470 of $1,000. Will be payable as tax. So instead of it just being a nice little, here's $1,000 bonus for everyone, here's $1,000 bonus for everyone that you didn't receive in cash, plus the business has to pay an extra 47% tax on that cost. So we try, as accountants, we try to avoid fringe benefits tax as much as we can because it feels like a waste of money to provide these benefits and then have to pay tax on top as well. However, that's not saying you don't do these things. We just do them in a tax smart way. So what's not classed as fringe benefits? So what things do you not pay tax on? Minor and infrequent gifts. So for example, you give a basket of flowers or a bunch of flowers to somebody to say happy birthday. This is minor and it's infrequent, so therefore fringe benefits tax would not apply on it. If it's a laptop computer used for work. The other thing I want to say about minor and infrequent is there's a $300 limit on it per gift. So if it's a $250 bunch of flowers this month and then another $250 bunch of flowers in 5 months' time when they have a baby, for example, then minor and infrequent would still be classed as that if it's less than $300. If you're giving your employee a laptop that they can use for work, and sometimes there's a private component to that, then there's no fringe benefits tax on that. This one I found really interesting. So if you've got a business where you've got lots of tools, your employees can borrow the tools for private use and have no fringe benefits tax on that. So that's pretty cool. So if you've got a chainsaw in the back of the ute and they go and chop down their private tree in their backyard, then hey, all good, no fringe benefits tax. I don't know who's documenting those sorts of things anyway, but that's no fringe benefits tax. And then salary packaging superannuation. So then they're taking money out of their pay to put towards superannuation. There's no fringe benefits tax on that either, because it's going straight to their super, and they don't really get the benefit of that salary packaging until they retire. So those are some of the things that we encourage businesses to do instead of the payment and the using cars and things like that. So these ones are the more allowed things. And then the final catch-all rule, which is total jargon by the tax office, is called an otherwise deductible rule. So if the employee would normally be able to claim something on their tax return, then we can provide it for them, and there'll be no fringe benefits tax. And so a great example of that would be you want to give them a fully kitted out toolbox. And so if they went to their if they bought it in their own money and they went to their tax agent, the tax agent said, yep, that's fully claimable, then you could give that to them out of your business money rather than having the employee pay for it, and it's claimable for the business and there's no fringe benefits tax on that. So it's a big, wide catch-all of otherwise deductible. So it can be anything from donations to tools to using, my brain's gone fried. So the other thing with the fringe benefits tax is you can't get around the fringe benefits tax by giving the item to a spouse of the employee. So you can't go, oh, you know what, Joe, your wife Jodi, we're going to give her a car instead of you. The rules don't work like that. So the rules are all encompassing with the employee plus their spouses, and the jargon for it is affiliated associated persons, so children even, and directors of companies as well. So even if you're not on the books as an employee, as a director, if you're receiving any of the taxable benefits, then the company will be liable for that fringe benefits tax as well. So that's FBT, really, really confusing and really, really hard to bring down onto 3 slides. I've got one more slide left. The weird but true thing with FBT is that if you pay fringe benefits tax as a tax, it is tax deductible, which is so unlike every other tax. Your GST is not tax deductible. It's a tax outside of the tax system. But fringe benefits tax is tax deductible if you pay it. So that's the silver lining. If you pay $1,000 worth of fringe benefits tax, if you're a company, you get a $250 tax, like you reduce your tax by $250. Weird but true. Different employers have different tax registrations and tax thresholds. So charities, hospitals, and not-for-profits have different rules than normal business employers. So you might hear, if you're talking to people, they've got $30,000 worth of benefits or $17,000 worth of benefits. Charities and hospitals have different benefit limits before they start paying fringe benefits tax, whereas us poor little normal employers don't have any thresholds at all. And then with the fringe benefits tax, if you provide something to your employee, then so we've got 2 months, so from April to June, to prepare and lodge your fringe benefits tax. And then you'll receive a reportable amount to go on their income statement. So I'm using the proper jargon for income statement, but this is the old pay-as-you-go summary statement. the group certificate is the real words that I started using 20 years ago. So on their group certificate 20 years ago, or income statement today, you'll put on the reportable amount of the benefits that they've received, and that can impact on their personal taxes, such as Medicare surcharge, help repayments, Div 293 super payments, health insurance rebates, and family assistance payments from Centrelink as well. So we want to try and reduce the impact that fringe benefits has on your business. Please put any questions in about FBT into the chat if you've got any, before I jump into no ABN withholding tax. So with this tax, this is the weirdest tax, and I've actually seen 0 people pay it because it is all about if you don't have an ABN. So if you deal with somebody and they don't have an ABN, then you've got 2 different options. The first one is withhold 47% tax and pay it on your business activity statement. Now, when you turn around and say to somebody, hey, you've given me an invoice for $100, but I'm only going to give you 53, what do? They go, oh, you know what? I'll either get an ABN or I'll fill out this statement by supplier form. So the statement by supplier form is a little form that they fill out saying, hey, you know what, I don't have an ABN for this particular reason. And the main reason is because it's a hobby and they're not expecting it to be business income. And so you can then pay them the whole invoice amount if you get a statement by supplier form from them. So I've never actually been involved with anybody withholding the 47% tax because either they rock up with an ABN or they rock up with this statement by supplier form. The next tax that you might come across as a business owner is capital gains tax. So if you sell an asset such as shares, land, property, or other investments, so if you own shares in your business of another business, then when you sell those things, then if you make a profit, then you might pay capital gains tax. Now, it does not apply to motor vehicles or plant and equipment that is used within the business, so that's just tracked as normal income tax rather than the special capital gains tax. And when you're selling your business as a whole, so if you wrap it all up and go, I'm out, I'm ready to go, find me somebody who's going to come and take over this whole business, then there may be some capital gains tax rollovers that allow you to not pay capital gains tax, or significantly reduce the amount of tax payable. And some of these initiatives, there's 4 different initiatives, but some of them might include swapping it out for a different business or putting some money into superannuation to reduce that tax. So lots of different options there. So capital gains tax is essentially for those bigger assets in your business. So something to be aware of, but nothing to be alarmed about. It's generally the same amount of tax as a company. It's 25%, or for a sole trader, you can get some discounts to reduce that tax as well. So generally not as scary as the fringe benefits tax, definitely. The other tax that you might come across if you own land within your business, so if you own a block of land and trading out of, for example, you might come across land tax. So this is a state-based tax and it's due at the end of the year based on the value of the land at the 30th of June. And if you own a house that has council rates as well, then this is based on land values as well. So your land tax is a state-based tax. So the state revenue department in your state will send through based on the value of that land. So nothing that I get involved in as a tax agent, but it's definitely something that you will come across if you own a piece of land. Now, if you personally own a rental property as well, you may be subject to land tax as well. Transfer duties are the last taxes that I'm going to run through, and this is a state-based tax as well, and generally applies where you're buying or selling assets such as vehicles, businesses, land, and property. So this is an assessment that's done based on your state, and each state has its own rates, its own rules, and its own exemptions as well. So I'm not going to go into full detail, but if you're selling a piece of land, or if you're selling your business, or even if you're selling your vehicle, that's done through the motor vehicle department, there's those transfer duties to pay. And the tax is then based on the contract date and the contract amount. Okay, if you're running a company, then I'm going to do a little bit of a demonstration on how dividends can impact on your personal tax as well as the company's tax as well. So if you own a company, chuck a little yes in the chat box and keep your eyes and ears open. So, yep. So your business running as a company, then we might come across some of this jargon and terminology. A franked dividend is a share of the profits of the company where tax has already been paid. So if we own a company and we've run our profit and loss statement, we've worked out what our profit is, we've lodged our tax return, and we've paid the tax on that profit, then we've got some franking credits hanging around. And the franking credits can be stuck to the dividend that is then sent out to the owners of that company in the form of a franked dividend. So going back to one of the previous examples, where a company makes a profit of $60,000, they pay tax of $15,000. The company is then eligible to pay dividends to the owner of $45,000. Now, I'll put in here allowing for cash flow requirements, because there's some businesses out there who might, on the books, make a profit of $60,000, but not have that much cash in their bank accounts. So if you don't have the cash in your bank accounts to make a dividend or pay a dividend, then this is where we can filter it through and do it at a later stage. So it doesn't all have to be paid out at the same time. So we can then pay a cash dividend of $45,000 because we've made a profit of $60,000. We've paid tax out of that of $15,000. So we've got $45,000 worth of cash left over. The tax that we pay, so the $15,000, is known as franking credits. And those franking credits are then stuck to that dividend and passed on to the owners with the dividends to reduce the double taxation of that same income. So the income the company has made is $60,000, and the tax they've paid on that is $15,000. So if we just stick the $45,000 in the owner's tax return, then they're going to pay tax on $45,000. So instead, what we do is we attach that $15,000 and use it as a credit for that $60,000 worth of profit that the owner has taken out. So let's do a little bit of a guide here. So with this other income, this is other income that the individual or the shareholder or the business owner of that company has already got in their tax return. Then we add on the dividend. So it's a $60,000 in the books dividend, which is made up of $45,000 worth of cash and then $15,000 worth of franking credits. So all up, the tax they need to pay, and I don't know if you were paying attention, but about 20 slides ago, we worked out that the tax on $60,000 was $11,167. So the difference between the tax that we have to pay based on our taxable income, which is $11,167, and the tax that the company's already paid, which is $15,000, gives us a refund when we lodge our tax return of $3,833. So when it comes time to lodging our tax return, we've already paid the tax, or the company has already paid the tax, and we're getting a little bit back because of the tax rates that we've got. Whereas on the flip side, if you're already receiving a wage out of the company and of $60,000, so I'm going to use the $120,000 example. If you're already receiving a wage out of the business and it's already paid $11,167, then we add that dividend on top, which is made up of $45,000 in cash plus the $15,000 franking credit. that gets us to a taxable income of $120,000. So $120,000 tax on that, the tax payable on $120,000 is $31,867. So there is more tax that we have to pay at that $120,000 mark than so we'll end up with a tax bill to pay. And the reason for that is because the tax rate is 25% for a company. So this $15,000 is based on the 25% tax bracket for the company, and our personal tax bracket is 32.5% plus the 2% Medicare levy. So knowing that we've got a credit there at 25%, we can do a couple of different things. Number one, pay a pay-as-you-go installment. So outside of any other tax system, just pay extra tax to the tax office. Or if your wage, so this $60,000 here, comes from your business, we can increase your tax that you pay so that you don't have a bill to pay when you lodge your tax return. So with a little bit of tax planning and a little bit of strategy, we can then go, okay, well, what is it that we're going to end up with at the end of the year? Do we need to make more tax payments? Of course, the tax payments come out of the company as pay-as-you-go withholding. So just wanted to highlight that the more income you earn, the higher your income, your taxable income, the more of a top-up tax you're going to pay, because the tax rates as individuals increase the more you earn, but the company tax rate doesn't. It's just that flat 25%. So we can factor that in when we're doing tax. Right. Recommendations about dividends and franking credits. So recommendations. Company making losses can't make dividends because you've not made any profits to distribute. A dividend is a profit distribution. For our small business owners, we do recommend a mix of wages and dividends for established business owner payments. And the reason for this is because we get that top up of superannuation, you get that pay-as-you-go withholding paid on your behalf, and then you get that bonus of a dividend and take advantage of the tax that the company has already paid. It's really important where your income levels are higher, though, so that to do some tax planning so that you're not out of pocket when we lodge your tax return at the end of the year. The third thing to note is that dividends don't need to be paid at the end of the year. So we can use a profit bank account. So this is using the profit first methodologies and actually save money for our dividends using a bank account set up specifically for that purpose. So we can have a bank account called profit or have a bank account called dividends and put a percentage of our money into that bank account every week or every fortnight so that we've got the money for dividends when we want to take money out of business. So it's really a powerful tool to set that money aside every week in order to get you to a stage where you can draw down that money for dividends. It's like a little buffer savings / holiday account. I've got some of my clients using their profit bank account to pay for a house deposit. I've got some of them because they want to travel as well. So lots of different reasons why you will have a profit bank account, but to put money in there to have ready for you to take dividends out whenever you're ready is really powerful tool. Okie dokie. So I've touched on tax planning quite a bit throughout all of the slides. And what we talk about with tax planning with Northwest Accountancy is that we're minimizing your tax and preparing early for tax bills, which is like two pieces of this timely taxes focus that we deal with our clients. So working with your accountant or us to plan out your taxes schedule for the year, to set aside a percentage of your income each week so that you know how much money is there for tax, is making sure you always know you have enough. Because before I started using the profit first method, it was, oh my gosh, the BAS is due again. Where are we getting this money from? it's almost what's more important, wages or taxes? And you don't want to have to make that decision. So having a bank account set aside means that you'll always have enough for tax. And it doesn't then impact on other payments. So you're not making that constant decision. Do I pay my telephone bill or do I pay my tax? We've got it set aside. It's quarantined. We know how much is there. And same with the dividend and the profit bank account as well, is it's not going to impact on any other payments because the money is already sitting there for that purpose. So we are in tax planning season right now. So if you haven't got a tax strategy session booked in with us and you would really like one, please let me know. Put in the comments save tax right now, and we will be in touch with you after the meeting or after this session to see what sort of a meeting you would like, whether you're just like a straight tax planning, how much tax am I going to pay next year, or a bigger strategy session where we can work through some of the biggest strategies to help you save tax and save time and make a better business. So that's our tax planning strategies. Now, I did say at the top of the call that I was going to talk to you about elevation training as well. So elevation training is giving you information on taxes, cash flow, reporting, bookkeeping, business structures, and running your business, all under the one module of what we're calling elevation training. So we've got the system set up to help you in each of these areas, and more information is being loaded into our online library every month around these areas. So how to run your business in relation to cash flow clarity. So there's training on there on how to set up profit first in your business. There's information on timely taxes. And when I finish recording this, this whole webinar will be up in the elevation training module as well. Then we've got strong structure. So what are those things you need to think about when you're building a business to thrive and thrive? And then relevant reporting. So how to do your bookkeeping. So we've got modules on Xero as well as modules on MyOb as well, telling you how to do your bookkeeping, but also how to run the reports that you need to run to make sure that your business is running on an even field, and what things you need to know about. So I'm the host of most of the training on the elevation training. So if you loved today, then you'll definitely love elevation training because it's in smaller bite-sized pieces, not the full 90 minutes that we've done today. So you can see here, all the little bubbles represent all the different types of training that are included in the online training. And then we've also got extras on top of the online training as well. So specialist advice set up with me, as well as Carrie, who's my other business partner, where we run through some of the Q&A calls with group training sessions like this as well, and tax reminders also. So lots of different ways. And then we do, I haven't put it in here, but there's quarterly check-ins as well. And you don't need to be an accounting or a tax client with Northwest Accountancy to join the training, so you can just join up. Our launch price, so in July, elevation training will be $297 a month, or for the next 2 months, so until the 30th of June, it's going to be $97 a month. But if you're here and if you want to get a month's worth free, actually it goes to the 30th of June out free, then please type in join, because I am giving away one free ticket to 2 months worth of training essentially for free under elevation training. So type join in here and I'll give you a free session. Or send me an email and we will send you through to the biggest. Now, if you do want to contact me outside of this training, then please contact me on Facebook or website or YouTube or any of those places, or my email address is jodi@nwapilbara.com.au. Now, If you have any questions, I'm going to stop the recording in just a moment and I can take your questions offline. Thank you so much for joining me today. Have a great day.